back in 2016, 2017, I wanted to start focusing more on macro. And it was because we had an unusual divergence between the deficit and the economy. So if you look back in modern history, normally, the deficit's smaller during a strong economy and it's weaker during a recession. But we started to get this divergence in 2016, 2017, where the deficit was actually getting worse while the economy was still strengthening. A couple reasons, but a key one was the baby boomers were kind of reaching their peak retirement years. And so the demographics of the nation were structurally changing for the worse deficit-wise. Then it was amplified by the fact that we had tax cuts that were not funded by spending cuts, and so that added to the deficit. Then of course COVID blew it out, and then even after that, now what we're getting is the interest expense is blowing it out.
In 2022, as the U.S. Federal Reserve and other central banks embarked on a series of rate hikes to combat inflation, economists and macro analysts shared a common concern about the potential impact on the economy. Despite valid worries, the rapid rate hikes proved successful, with most economies remaining resilient, aside from occasional challenges like the U.S. regional banking crisis in April 2023. The battle against inflation may have been won, but the war is far from over. The United States faces a daunting situation with a debt-to-GDP ratio approaching 130% and a budget deficit of nearly $2 trillion. This forces the Treasury Department to issue more debt than planned, leading to higher borrowing costs amid elevated interest rates, exacerbating the challenge of managing the massive debt load. Renowned macro analyst Lyn Alden sheds light on these economic complexities in a recent interview with Natalie Brunell. Alden discusses the turning point in the U.S. economy 8 years ago, highlighting the unusual divergence between the budget deficit and the economy. Despite not being in a recession or directly involved in a war, the U.S. is accumulating a substantial budget deficit of almost $2 trillion. Alden emphasizes the potential widening of this gap due to underlying issues such as demographic shifts, reduced tax revenues, and increased borrowing costs, providing insights into the economic landscape for 2024 and beyond.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
How were we able to raise this much and not trigger some sort of massive crisis or hard landing?
Well, so that's why it surprised me initially, and I had to kind of in real time take into that account the information that's happening and see what's happening with the models. The main answer I would say is that the fiscal was larger, and so if you look at the first 3 quarters of 2022, that's when you had the full force of the tightening. So the rates were going up, the balance sheet was going down at the Federal Reserve, and the Treasury and the fiscal side was not really offsetting it at all. So it was just, assets across the board were down, everything was down, the economy was decelerating by almost all metrics. But starting in that kind of fourth quarter of the year, that's when you started to get the Treasury offsetting the Fed. So first they began dumping their Treasury general account cash back into the market, which is pro-liquidity. And they continued doing that all the way up through May of last year, 2023. And then the second lever they pulled was to start issuing more short duration bonds than long duration bonds. And that allowed them to pull capital out of the reverse repo facility and push that back into the market. And so the Treasury's done 2 different types of actions that have more than offset the Fed's liquidity drain. And so that's been beneficial for both U.S. markets and to some extent global markets because it took the edge off the dollar index. And as you know, there's a lot of global debt denominated in dollars. And so when the dollar strengthens relative to other currencies, a lot of those companies get squeezed. You don't want your income to be in the weak currency and your debts to be in the strong currency. But ever since that exact moment, that fourth quarter of last year, we saw the dollar index kind of come off its highs, which then gave the globe kind of some breathing room. So that was a big factor. And then 2, the interest rates were interesting because that was surprising. I would say one is that there's just so much liquidity in the system, so much extra cash still in there. That it kind of gives a lot of buffer to get through it. And 2, it's the fact that, the kind of the middle class, upper middle class homeowners have a lot of that debt is fixed rate, mortgage debt kind of fixed rate. Investment grade corporations, again, a lot of that's low fixed rate. So very little of that is actually impacted these entities. Mostly it's felt in small businesses, which use shorter duration bank loans normally, um, non-investment grade corporations, so junk rated corporations that generally have shorter duration debt, um, people that rely on credit cards. So, working class and kind of lower working class, they're more impacted, unfortunately, by some of these policies. And then ironically, the federal government itself has pretty short duration debt, on average something like 6 years.
Mm.
But a lot of that's like front loaded in the first year or two, and then they have a long tail that goes out to 30 years. And so they're actual centers in that first few years. So they start exploding out interest expense. And what a lot of people don't realize is that interest expense, all these deficits on the federal side are someone else's surplus.
Mm.
So they could be flowing into offshore investors that own the treasury debt. They're flowing into onshore investors that have money markets, that have T-bill exposure. Kind of, any sort of mid-duration bond or lower is doing pretty well. There's been a re-increase in the wealth effect from equity prices and real estate prices kind of bouncing back on a nationwide average. Um, and so that was kind of a big factor for how we were able to get through that. And again, the challenge was, if you asked a lot of people in early 2022, including me, can they raise to 5% and it not, kind of blow things up? We would have said, oh, probably not. But I think the key is that you respond to information early when it starts to happen. You say, okay, what is happening that I didn't necessarily predict, and what is the sequence of events playing out? And so it was important to be to kind of move with that as it happened.
On Thursday, the Labor Department released its December 2023 inflation data, revealing a 0.3% month-over-month increase in the Consumer Price Index, surpassing the estimated 0.2%. Annually, the CPI closed 2023 with a 3.4% increase, higher than the Dow Jones estimate of 3.2%. The core CPI, excluding food and energy prices, rose 0.3% in December and 3.9% from a year ago, slightly exceeding economist estimates of 0.3% and 3.8%, respectively. Despite overall optimism about easing inflationary pressures, the data indicates persistent challenges. Rising shelter costs, particularly noteworthy, increased by 0.5% in December and 6.2% annually, contributing significantly to the overall CPI increase. Concerns are growing among experts, as the higher inflation data suggests a potential stickiness in inflation, signaling tougher times ahead for both the US and the global economy. While some predict double-digit inflation for the US by 2025, Lyn Alden's inflation predictions are slightly more optimistic.
So my case for a while is that the 2020s on average be more inflationary than the 2010s, and but that it wouldn't be a straight line. So we got the initial inflation spike. I started talking about disinflation. We started to see monetary tightening, kind of harder base effects when you're measuring things year over year, and so that's played out. I think a key question going forward is there's a couple ones to watch. One is, what does energy do? Right?
Mm.
Because whether or not we have price inflation of double digits a year or two from now, there's very kind of flowchart Boolean outcomes. Like, does Iran's oil come off the market or not? Right? That's
Yeah.
because that's if you list things how you can get to double digit inflation. So right now I'm saying I would take the under, but where would I be wrong on that? It's if we have some sort of major energy crisis, for example, and that's more of a geopolitical question than a predictable economic question. So it's making sure you know the variables that could lead to certain outcomes. So I do expect in the 2020s that we will have more energy scares and more periods of kind of frighteningly high oil or gasoline prices, or in some cases, natural gas. I don't necessarily know what's going to happen in the next 12 months. There's certainly variables that can make that happen. Um, I you know I've been trying to kind of stick to a 2 year time frame, kind of 2024 and 2025, because I do expect within that 2 year view, we're probably going to have another liquidity cycle. We're probably going to have another rising economic acceleration within that 2 year period. And so if we do get that, I would expect inflation to come back with that. But again, I don't know if it would be double digits, because that would partially depend on what's happening with energy shortages.
Gotcha.
Um, and another key factor to watch is, so we talked about liquidity
Hmm.
and the offsets that's been happening. So there's still about $1 trillion in reverse repos that
Hmm.
can be pushed back into the market. A question is, what happens after that? Does the Fed start going back to kind of gradual balance sheet expansion? And that could be a turbulent period when you're potentially doing a handoff from the Treasury's liquidity drain to the Fed, because they might not want to jump in right away, if they're still, trying to get inflation back down to their official targets, the way they measure it. And so I think we could have pockets of turbulence, but I do expect over the next 2 years probably to see that another liquidity cycle, another economic reacceleration cycle, and inflation to come with it. And the question is, does that start in mid 2024? Has it already started? That's something that we're still monitoring, because liquidity suggests it has probably restarted, but we're not really seeing that in the economic data yet. And so I still am kind of worried about kind of the, call it, first 6 months or so of 2024. We'll see how that plays out.
While Lyn Alden is awaiting more substantial indicators of immediate trouble before making further predictions, billionaire investor Bill Ackman takes a proactive stance, asserting that the Federal Reserve should act preemptively. In a recent CNBC interview, Ackman argued that the current cost of capital is excessively high, prompting the Fed to initiate at least 3 rate cuts in 2024 to prevent economic recession. He emphasized that, given the cooling inflation, the Fed needs to address the elevated real cost of money by moving early. Ackman believes that 3 rate cuts, amounting to a 15% reduction in rates from 5.2% to 5.50%, are necessary to mitigate potential damage. While the markets anticipate anywhere between 3 to 6 rate cuts from March 2024 to early 2025, the resurgence of inflation might complicate the Fed's commitment to lowering costs. Additionally, considering it is an election year, the Fed could face pressure to ease economic conditions and make voters more agreeable. How Alden's predictions align with these dynamics remains a topic for consideration. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.